The date matters, the time matters. And on this particular morning, every number that came out of Shanghai mattered more than most people in the Western world were prepared to understand. Shanghai explodes, silver reaches the $100, $10 premium. While West stalls at $86. While you were sleeping, Shanghai woke up, and silver told the world something that Western markets are refusing to hear. A $10 gap between what the East is paying and what the West is pretending. Physical silver clearing at $102. Western spot frozen at $86. Same metal, same planet, two completely different realities. And one of them is lying. The question is, which world are you living in? Welcome to Financial Crisis Explained, the one place where the numbers speak first and the noise is left outside. Now, before we go any further, if you found this channel, think of it like finding a good doctor after years of bad advice. You don't walk away, you stay. So if you're new here, that subscribe button, treat it like your morning newspaper. The one you've been reading for 30 years, reliable, honest, always there. Click it, you won't regret it. And one more thing, wherever you are watching this right now, whether you're sitting in Karachi, London, Dubai, New York, or somewhere in between, drop it in the comments below. Tell us where in the world you're watching from. Because this story affects every city on that list, and we're just getting started. Shanghai silver futures opened at $99 per ounce, not $88, not $90, not the number that Western traders were watching on their screens, $90. And Western spot price, going into that same open, was sitting quietly at 88.50. Same metal, same periodic table, same physical reality, but two markets, separated by geography, by structure, and increasingly by truth. Now, before anyone dismisses this as a routine price fluctuation, before anyone reaches for the word volatility as a comfortable explanation, let's establish something fundamental. Markets do not lie in the short term, they signal. And what Shanghai signaled on this morning was not chaos. It was not speculation running wild. It was not irrational fear driving prices upward without cause. It was demand, real, physical, documented demand. But to understand what happened at the open, you have to go back slightly further, because the most important signal didn't arrive when the exchange turned on. It arrived before it did. In the days preceding this session, physical demand data was already emerging from Shenzhen recyclers, industrial buyers operating deep inside China's manufacturing supply chain. These are not paper traders. These are not speculators sitting behind terminals making macro bets. These are businesses, real operations, organizations that need physical silver to function, and they were submitting bids running $5 or more above the SHFE pre-holiday close. Read that again. Before the Shanghai Futures Exchange even reopened after the holiday, physical buyers in Shenzhen were already willing to pay a significant premium above the last known price. That is not noise. That is the market speaking in its clearest possible voice, telling anyone willing to listen exactly where physical demand was priced before a single futures contract changed hands. The exchange had not yet opened. The session had not yet begun. And already, the physical market had made its position known. This is what most retail investors never see. They watch the opening price, they react to the closing number, they interpret candles on a chart as if the chart is the market. But the chart is only the surface. Underneath it, physical demand had already been building pressure for days. And when Shanghai finally opened, that pressure was released. $99 at open. Then the session began to move. Price pushed steadily, deliberately upward, climbing through levels that Western analysts were not modeling for, reaching all the way to $102 per ounce. $102. For context, Western spot price at that same moment was trading near $86. That is not a rounding error. That is not a data discrepancy. That is a $16 intraday gap between what physical silver was clearing for in Shanghai and what paper silver was being quoted at in the West. The session eventually closed with an average of $97. But here is the detail that deserves its own moment of analysis. The final physical lot of the session, reportedly cleared at $102. Now, a legitimate debate exists here, and serious analysts will engage it honestly. Does the session average of $96 more accurately reflect true demand? Or does the final physical transaction at $102 represent the truer signal? The last price at which a real buyer and a real seller agreed to exchange real metal? Both numbers are defensible. Both have analytical merit. But here is what is not debatable. Both numbers are above Western spot. Whether the true demand signal is $96 or $102, it does not matter for the core conclusion. Because the core conclusion is this: Shanghai is pricing physical silver at a level that Western markets are either unable or unwilling to match. And when two markets price the same asset this differently for this long, something is being revealed. The only remaining question is whether you are positioned to understand what that something is before the rest of the world catches up. There's a number that should stop every serious business person cold, not because it is dramatic, not because it triggers fear, but because historically, when this number appears between two major markets pricing the same physical asset, what follows is never small. That number is $10. And right now, it sits between Shanghai and the West like a fault line that neither side is officially acknowledging. Shanghai physical silver clearing near $102. Western spot quoted at $86. A $10 premium, at minimum, separating east from west on an asset that should, by every principle of efficient market theory, price within cents of each other globally. It is not pricing within cents. It is not pricing within dollars. It is pricing within a gap wide enough to drive an entire monetary thesis through. And that thesis is what this part of the story is about. Let us first establish what a premium actually means, because the word is used casually and understood poorly. When Shanghai buyers are paying $10 above Western spot for the same physical silver, they are not making an error. They are not overpaying out of ignorance. These are not unsophisticated actors operating without information. These are institutions. Industrial end users, state-adjacent entities operating inside the world's largest manufacturing economy. Organizations that have access to the same global price feeds that every Western trader has, and they are still paying $10 more. Which means one of two things is true. Either they believe the Western price is wrong, or they need the physical metal badly enough that the premium is simply the cost of access. Both interpretations carry the same conclusion. Western spot price is not reflecting physical reality. Now consider what was happening in Western markets during the Shanghai session. Volume was almost stalled. This detail is not a footnote. It is the entire story told in a single data point. Low volume in the West, heavy premium in the East, physical bids running well above paper price on the Shanghai side. When you see this combination, you're not looking at a temporary pricing anomaly that arbitrage will correct by morning. You're looking at a structural divergence, one that has been quietly building beneath the surface of the official narrative for longer than most market participants have been paying attention. Here is why that combination is significant. In a functioning, efficiently connected global market, a $10 premium between East and West would immediately attract arbitrage capital. Traders would buy in the West, sell in the East, pocket the spread, and in doing so, collapse the premium back toward equilibrium. That is the textbook. But the textbook assumes the physical metal can move freely, that delivery is accessible, that the arbitrage is executable in practice, not just in theory. When the premium persists, when it holds across an entire session while Western volume stalls and physical bids keep running above paper, it tells you that the arbitrage is not being executed. And the reason it is not being executed is not ignorance, it is constraint. Physical silver is not moving from west to east at the scale required to close this gap. And the reasons for that constraint, whether logistical, political, or structural, are less important in this moment than the signal the constraint produces. The signal is this: Eastern physical demand is outrunning Western supply capacity. Now, let us place this in historical context, because this is not the first time a premium of this magnitude has appeared between Eastern and Western silver markets. Each prior instance carried a pattern. Physical premiums of $8 to $12 sustained over multiple sessions have historically preceded one of two outcomes: either a sharp upward repricing of Western spot to close the gap from below, or a physical supply event that forced the market to confront what paper pricing had been concealing. Neither outcome was comfortable for those who were not paying attention. Both outcomes were entirely readable for those who were. The $10 premium sitting between Shanghai and the West right now is not a curiosity. It is not a talking point. It is a measurement. A precise, documented, market-generated measurement of how far official Western pricing has drifted from what physical buyers on the other side of the world are actually willing to pay. And in the language of markets, when the measurement reaches this size, the correction that follows is rarely gentle. There is a concept in market structure analysis that requires no algorithm, no Bloomberg terminal, no institutional research desk to understand. It requires only one thing: patience. The patience to watch a level, be tested once, hold, watch it, be tested again, hold, and then watch it be tested a third time, and hold again. Because when a market returns to the same level 3 times, and 3 times walks away without breaking through, it is not repeating itself randomly, it is communicating. And right now, Western Silver Spot is communicating something that every serious analyst, every strategic business planner, and every entrepreneur with capital at risk needs to sit down and hear. Western Spot Silver is currently sitting at $86.40. Not $89, not $91, not anywhere near the levels that the Shanghai session would logically suggest it should be gravitating toward. $86.40, back below a resistance zone that has now been tested, approached, and rejected 3 separate times. That zone sits between $87.20 and $89. It was not drawn arbitrarily. It was not selected for convenience. It emerged organically from price behavior, from the market's own repeated decisions about where it was and was not willing to close above, and 3 times the market made the same decision. Not yet. Now let us be precise about what rejection means in this context. Because the language of technical analysis is frequently misused, and in misuse, loses its strategic value entirely. A rejection does not mean price briefly touched the zone and collapsed violently downward. Markets rarely communicate that dramatically at key structural levels. What happened here was more deliberate, more institutional, more telling. Price approached the $87.20 to $89 zone, pushed into it, generated movement that on a surface reading might appear like an attempt at breakout, and then, quietly, without fanfare, closed back below it, not with a wick above, with a body below. This distinction matters more than most people realize. A wick above a resistance zone means price visited that territory. It means buyers made an attempt, sellers responded, and the session closed without confirming the move. A body close is different. A body close means the majority of that session's price action occurred above the level. It means the market spent real time, real volume, real conviction above that zone before closing. There has been no displaced violent hourly body close above $89. 3 tests, 3 sessions, 3 rejections. And every single time, the body closed below. Now here is where the story becomes genuinely uncomfortable for Western market participants, because this rejection pattern is not occurring in isolation. It is occurring simultaneously with everything documented in parts 1 and 2 of this analysis. Shanghai opened at $99, pushed to $102. Physical lots clearing at a $10 premium above Western spot. Shenzhen industrial buyers bidding $5 above pre-holiday closes before the exchange even opened. And Western spot is sitting at $86.40, rejected 3 times from $87.20 to $89. Unable, or structurally prevented, from reflecting what the physical market on the other side of the world is already pricing. This is the divergence thesis made visible in real time. East absorbing physical silver at $102, West defending paper levels at $86, and the technical structure of Western price action, confirming that defense with 3 clean rejections from the same zone. What does this mean for the serious analyst? It means one of 2 scenarios is now in play, and both deserve clear-eyed examination. Scenario 1, the resistance zone holds. Western spot continues to stall below $89. The premium between East and West widens further. Physical supply tightens. And at some point, the paper market is forced into a violent upward repricing event to close a gap that arbitrage alone could not correct. Scenario 2, a forceful hourly body close above $89 occurs. Not a wick, not an intraday spike that retreats. A body, sustained, confirmed, and with that close, the technical resistance that has held 3 times breaks. The market structure shifts. And what was resistance becomes support for the next leg of movement. Both scenarios have historical precedent. Both scenarios have strategic implications for anyone holding, planning, or building around commodity-linked assets. But here is what makes the current moment particularly significant. The zone has held 3 times. In market structure analysis, 3 rejections from the same level without a decisive break is not a sign of weakness in the resistance. It is a sign of accumulating pressure beneath it. Every test that fails to break a level does not simply reset. It adds weight. It adds participants on both sides who now have positions built around that level. It adds institutional memory to the zone. And when zones with that kind of accumulated pressure finally break, they do not break quietly. They do not break with a polite wick above $89 that retreats by the next candle. They break with the kind of move that makes people who weren't watching suddenly very interested in what they missed. 3 rejections, 1 zone, 2 possible outcomes, and a physical market in Shanghai that is already pricing silver at levels the Western tape has not yet found the courage or the structure to confirm the wall is holding. But walls under sufficient pressure do not hold forever. The only question that remains for the serious observer is not if this structure resolves, it is when. And more importantly, which side of that resolution are you on? Everything documented in this analysis up to this point. The $90 open in Shanghai, the $102 physical clearing price, the $10 premium sitting between East and West, the 3 rejections of Western resistance, the stalled volume, the structural divergence, None of it exists in isolation. None of it is happening in a vacuum, sealed away from the decisions you make daily as a business owner, an entrepreneur, a capital allocator, or a young professional building something in an economy that is quietly being repriced beneath your feet. This part of the story is not about silver. It is about what silver is telling you, about everything else. Let us begin with the most fundamental question that any serious business person should be asking right now. Who benefits when East and West price the same physical asset differently? And by $10? The answer is not simple, but it is readable. In the short term, those with access to physical metal in the East benefit. Industrial buyers who secured supply before the premium widened benefit. Entities that understood, weeks or months ago, that Chinese physical demand was building beneath the surface and positioned accordingly benefit. Those who were watching only Western spot prices, those who trusted only the paper quote on their screen, those who assumed that $86 was the whole story, did not benefit. And this is the first strategic lesson embedded in this data. The price you see on a Western terminal is not always the price the world is actually paying. For entrepreneurs and business builders operating in industries with any commodity input, manufacturing, electronics, energy, construction, logistics, this is not an abstract observation. This is an operational reality. Because when physical premiums of this magnitude develop between Eastern and Western markets, supply chains do not wait for Western spot to catch up before they begin repricing. They reprice immediately, at the physical level, where the real transactions happen. Now let us examine the industries most exposed to what a premium normalization event would actually mean. Silver is not simply a monetary metal. It is an industrial critical input. It is inside solar panels, inside electric vehicles, inside semiconductors, inside medical equipment, inside the defense supply chain, inside virtually every high-growth technology vertical that the global economy has staked its next decade of expansion upon. When physical silver premiums in the world's largest manufacturing economy run $10 above Western spot, and when that premium is being driven by industrial recyclers and physical end users, not speculative traders, the businesses downstream from that supply chain are already absorbing cost pressure that their quarterly reports have not yet reflected. This is the window that serious analysts understand and most market participants miss entirely. The financial statement is always the last place the stress appears. The first place it appears is exactly where we are looking right now, in the premium, in the physical bid, in the gap between what paper says and what physical buyers are actually paying on the other side of the world. Now for the monetary dimension of this signal, because silver has never been only an industrial story. Throughout recorded economic history, sustained physical silver premiums of this magnitude have appeared in specific contexts. They appear when currency confidence is eroding in one part of the global system. They appear when monetary policy divergence between major economies creates asymmetric demand for hard assets. They appear when institutional actors, the ones who do not announce their positioning on financial television, are quietly moving out of paper representations of value and into physical ones. The $10 premium between Shanghai and London is not merely an arbitrage opportunity that someone forgot to close. It is a monetary signal. It is the market's way of saying that in at least one major economic center, the preference for physical over paper has reached a price point where a $10 per ounce premium is considered acceptable cost of ownership. For young entrepreneurs building businesses in 2024 and beyond, this signal carries a direct implication for capital planning. When physical hard assets begin commanding sustained premiums over their paper equivalents in the world's largest economy, the question is no longer whether monetary conditions are shifting. The question is how fast, and speed is where the strategic warning becomes most urgent. These disconnects between physical and paper markets do not last indefinitely. History is unambiguous on this point. The resolution always comes. The gap always closes. But it closes in one of two directions. Either Western spot reprices upward to meet physical reality, or physical supply contracts to the point where the premium becomes the new normal. And every business operating without awareness of that shift finds itself repricing inputs in crisis mode rather than strategic mode. There is no third outcome. There is no scenario where a $10 sustained premium between the world's largest physical silver market and Western spot simply, quietly, disappears without consequence. The consequences are already in motion. The only variable is timing. So what does the serious decision maker do with this information? Not panic, not speculate recklessly, not make reactive capital decisions based on a single session's data, but also not ignore it. The businesses and entrepreneurs who will navigate the next phase of global commodity repricing successfully are not the ones who react fastest. They are the ones who understood earliest, who saw the Shenzhen bids running $5 above pre-holiday closes and understood what physical demand at that level means for supply chains downstream, who saw the $10 premium between Shanghai and Western Spot and asked not, is this real? But what does this mean for how I hold capital, how I price my products, how I structure my costs, and how exposed I am if Western Spot closes that gap from below rather than above? The signal from Shanghai is not waiting for Western markets to acknowledge it. It is not waiting for a news cycle to validate it. It is not waiting for the resistance zone between $87.20 and $89 to finally break before it becomes relevant to your business decisions. It is already priced, already cleared, already recorded in the physical transaction history of the world's most important silver futures market. The $10 premium exists. The structural divergence is documented. The 3 rejections on the Western tape are on record, and the window between when serious analysts understand what these signals mean and when the broader market finally prices them in, that window is exactly where strategic advantage lives. The question is not whether you now understand what happened in Shanghai. You do. The question is what you choose to do with that understanding before the window closes.